Well, welcome everyone to our annual webinar on startup financing trends, where we concentrate on what's happening in startup financings, focusing on the startups overall, and also concentrating on university startups as well. I'm Kirsten Loita of Osage University Partners. Today, I am joined by two of my colleagues. I'm very happy to have them here, Nabil Ullah and Justin Robeny, and I'm going to have them each introduce themselves. Nabil, I'll start with you.
All right, thank you. Hi, everyone. I'm Nabil Ullah. You've probably seen me on many of these financing trends webinars by now. I'm an associate on our tech investment team. I've been at OUP for 4 years, and prior to OUP, I worked at Goldman Sachs for 2 years. My background is in finance and mechanical engineering.
Great, thanks, Nabil. Justin.
Hello, everybody. Justin Robeny, a newly adjoined associate on the life science team at OUP. I did my master's in clinical research at Icahn School of Medicine at Mount Sinai, and also worked in clinical operations at Axsome Therapeutics. After that, I did my first stint in investing. I joined a fund called Octagon Capital, which specializes in biotech investments in both the public and private space. And then I joined OUP back in December.
Yeah, and we're so thrilled to have both of you here talking about financing trends for startups. Before we jump into our main subject matter, just some logistics here. We do record these webinars, so this will be posted on YouTube sometime next week. We will also be sending out the recording of the webinar to all of our registrants, as well as the deck itself. So just wait for that. Hopefully sometime next week you'll receive that. For those of you who are at our partner institutions, you will also be able to see this particular webinar on our partner portal, which you do need to register for if you have not already. There are QR codes here where you can go and either see our YouTube channel or go to our partner portal as well. You can also see a whole bunch of our past presentations on our YouTube channel too. We do have an upcoming webinar. Actually, already next week is our next webinar. It is Founding a Startup as a Graduate Student, and we'll have two startup CEOs sharing their own experience, Shelley Force-Aldred and Laura Schewel. So we'll have someone from both the life sciences side as well as the physical sciences side talking about their experiences of starting a startup as a grad student. And we're super thrilled about that webinar next week. So please join us for that. If you have any questions about that particular webinar, we'll put a link in the chat where you can register for it. So a little bit about OUP before we get into the webinar itself. We are a venture capital fund that focuses on investing in startups out of academic institutions, particularly in the deep sciences. Our fund is founded around the idea of investing through participation rights, which are the ability to invest in future rounds that the company raises, and have the institutions or their assignee, in this case Osage University Partners, has the right to be able to make investments in those particular companies. We have a lot of ways that we work with academic institutions. We do share portions of our profits with our institutions, as well as have a lot of programs that support both startups and tech transfer operations at the institutions, including webinars like this. We have been around for quite a while now, have made investments. Actually, this should be dated slightly. We've invested in over 150 different university spinouts at this point, with a lot of successful exits. This particular slide just gives you an idea of the areas that we invest in, both on the life sciences as well as the physical sciences side. Always happy to talk about our model with anyone. With that, I am going to just talk about a few of the things that we'll be covering today in our webinar before we pass it off to Nabil and Justin. We'll talk about the state of the fundraising environment. Very interesting right now. Then we'll move on to life sciences trends, then tech trends, and do a wrap up. We did receive some questions ahead of time, and we will be answering some of those as we go along through the different slides, and some of them we'll be answering at the end. If you do end up having questions throughout this webinar, but there's a Q&A tool in the Zoom bar that you have there. Please submit the questions through the Q&A tool so that I can read them to our presenters here and have them answer them. So with that, I will pass it over to Nabil.
All right, thank you. All right, slide, please. Perfect. All right. So, um, the first thing I want to touch on in this presentation today is the very obvious lack of liquidity in VC in recent years. And this primarily comes from stalled IPO markets. You hear it everywhere. Companies are scared to go public. They're staying private longer, raising extension and bridge rounds. The public markets are volatile. And then on that backdrop, M&A is still happening, but it's not nearly enough to backfill the liquidity that's typically generated by public listings. So the chart on the right here shows exit values by type, year, and quarter, where acquisitions are in orange and public listings are in red. And you can see historically that IPOs have always been the primary driver of liquidity. And M&A hasn't changed all that much, even when you compare it to the boom years of the 2021, 22. Um, and so without so many IPOs, things remain dry and will likely continue to until that IPO market kind of thaws out. Exits are happening, though. In fact, the number of exits in 2024, which is shown here as 1,259, it's actually in line with the pre-pandemic era. The problem, however, is that most of these companies are not creating enough liquidity in terms of exit value. And so that being said, exit value did slightly rebound in 2024, but it's a very small, it's a very small difference. And you can see that on the left-hand chart there. In fact, it was slightly higher than even 2022, but again, these are very marginal differences. So there's a bit of hope that things will start to trend upwards. We have a lot of companies looking to exit, but it'll take some time for those companies' value to really shine through so that they can demand larger premiums on those exits. Slide. And then the second part the second point I want to make here is a fairly obvious one, actually. You hear it in the news, AI this, AI that. You can probably smell it in the air now, too. AI dominated the markets in 2024. And I'd really love to quantify the sheer magnitude of it because it's truly astonishing. The chart on the left shows US VC deal activity by year. And in 2024, startups raised about 210 billion, which is historically higher than every year in the last decade other than 2021 and 22. The crazy part is almost half of those dollars, so about 100 billion, went into AI alone. And nearly 1 in 3 deals in 2024, and that's around 5,000 deals, was all AI. So these seem to be the only companies that can consistently raise oversubscribed rounds at premium valuations. To put all of this very simply, 30% of all deals in 2024 fueled roughly half of all deal value. So what does that mean? Well, we see investor FOMO often. That's fear of missing out. And we see it come and go in different verticals over the years. We saw it with climate tech a few years ago, which we'll touch on later in this presentation. So you could call this another hype cycle. You could even go as far as calling it a bubble, but we don't know. What we do know is that AI seems to be the only vertical that's been insulated from the struggles that a lot of startups in other sectors have faced, including biotech, which my colleague Justin is going to go over next.
Great. Justin, over to you.
Okay, great. Thanks, Nabil. So this slide indicates the trends for healthcare investment in total. And as you can remember, in 2020 to 2021, the healthcare investment space saw a big boom over the course of the pandemic, driven by some of the excitement from the COVID vaccine. And then slightly after that, from 2022 to 2023, there was a dramatic decrease in both the deal count and total investment in the healthcare space broadly. So what's interesting as we looked at 2024, if you look at the sort of line graph at the top, that is measuring the total deal count. And then the bar graph is measuring the total investment in dollars and then broken down into percentages of each sector into that total deal volume. So biopharma in green, health tech in blue, tools in purple, and device in red. So what the interesting trend here is we actually saw a normalization and uptick, a dramatic uptick in the deal count in total healthcare deals. However, the investment dollars is still trending upwards, but not totally, up to the par of healthcare investment during the pandemic. And I think that makes sense because valuations were super high in 2020 due to what we can call a bubble at that time. So as we go to 2024, valuations are more realistic. And with those more realistic valuations, there's also less investment dollars going into these bigger companies. So with the trend here, as we have more deal count, but less, dollars going in, there's still excitement into the space as we're seeing with more deals. However, there might be less funding and more realistic viewpoints on funding big rounds to get these companies forward. So the other interesting trend here is if we take a look at each subsector and the year-over-year growth on the right, you can see that biopharma actually had the biggest increase in year-over-year growth of VC investment, about 36%. And healthcare tools and device did have some positive trends from 2022 to 2023, but not as large as biopharma. And there could be many different reasons for that. I think one in particular, as Nabil mentioned on a prior slide, is sort of the AI investment. This theme is sort of coming over to the biopharma side. And some of these AI companies have large pipelines and require large investments. And so some of those companies are taking a big chunk of the VC dollar investments and adding to this year-to-year growth. But let's click in more into biopharma and go to the next slide. We'll see another interesting trend happening specifically within biopharma. So if we look at the left graph first, the sort of top will show you the total amount of VC dollars going into biopharma in particular. And then in parentheses is the deal count. So as you can notice, the deal count specifically in biopharma has actually decreased. And we're looking at both total dollars and seed A dollars to 117 total deals in 2024 and 568 total deals of 2020 total deals in 2024. But what's interesting is that seed A dollars do remain a large portion of the total dollars going into biopharma companies, accounting for 32%, with $7.8 billion raised again across 117 deals. So what I think this means is it's actually reflecting, a larger focus and larger investment in these Series A deals in particular, despite the declining deal volume. And I think that's another trend that we've been noticing at OUP is we're actually seeing larger, Series A investments. In the past, you would typically see a Series A investment of 30 to 40 million, and now you're seeing them quite larger through 100 million. And part of the reason for that is, as sort of the market leads to more uncertainty, investors want to see their dollars run through more value inflection points and see their dollars through maybe some more proof of concept data, whether it's through IND or actually through the clinic now, and actually seeing their dollars fund clinical data that supports, the valuation of the company. So you can go to the next slide.
Just took a bit, sorry.
Yeah, no worries. So this slide's looking specifically at university therapeutics, and it's a similar trend. So we're seeing the deal count in green decrease from 352 to 311, but the total capital invested also increases. So there was about a 29.6 increase from the 8.1 billion in 2023 to about 10.5 billion in 2024, despite a 11.6% drop in deal count to 311. So again, I think this also shows focus that, despite, lower deal count, there's still excitement in the space, and investors are funding the companies that they view as more exciting instead of throwing VC dollars around and funding every deal. There's less deals, but they're funding the companies that are maybe more exciting and have potential to generate proof of concept data with their VC dollars. So if we look at the right, another interesting trend, which does point to a little bit of more optimism in the space, is that pre-money valuations actually increased from 2023 to 2024. So from 60 million to about 76 million. And again, the deal size is also increasing. There was a very large, if you look at the bottom, there was a very large deal in the biotech AI space. So that is Exira, if I'm pronouncing that correctly. I think that was almost like $1 billion deal, so that really drove up some of the measurements here. But again, I think the overall trend here of lower deal count, but larger investment is a positive trend, but also pointing to more realistic valuations and consolidated investments in exciting companies. Go to the next slide. So first-time financings in university therapeutics. This is specifically focusing more on earlier stage seed funding and angel funding. So I think again you're seeing a similar trend here where seed count is going down, as well as the total angel deal count. However, the seed deal size actually surged about 70.9% from 2023. And this is a similar trend as we saw on the prior side. So fewer but larger investments as investors become more selective. However, there is a sort of disconnect now with the angel funding. So angel funding hit a decade low of capital raised and deal count. So I think this is showing a trend of a diminishing role of your angel investors as more institutional investors are doing larger seed funding than some of your more angel investors. Go to the next slide. So device has been quite resilient. There hasn't been a dramatic change for 2024. So the total device investment, and this is across US and Europe, reached about 6 billion across 433 deals. So there's a slight decrease in deal count, but the total investment dollars remained quite stable. So if we look at the right, the median deal size did improve across all stages. So the Series A reached about 9 million, a slight increase from the 8 million in 2023. And Series B, however, if we take a look at some later stage funding, had a little bit of a larger increase, hitting 20 million, signaling stronger valuations despite fewer deals. And two of notable areas in device that's gaining some traction here is neuromodulation and AI in robotics. Go to the next slide. So if we look at university medical device, we're seeing here both declining deal activity and declining investment in this space. So the deal count is about the lowest in a decade. It's about 94 deals done in 2024, while maintaining 1.1 billion capital deployment. I think again we have more selective investment here. Larger average size investments if we're considering 133 to 94. So on a average level, you're seeing larger deals with smaller deal count. So you look at the pre-money valuations, a little bit of a more positive trend here in 2024, where pre-money valuations did increase from 2023 to 2024. It's about a 60% increase from 10 million to 16 million, as the deal size did double to 2 million. So that is quite more of a positive trend in more investor confidence in university device innovations. Go to the next slide. So tools is lagging behind the other sectors. And what we're seeing specifically with tools is, we had a huge increase in 2021 and 2022, but after 2022, the tools and diagnostics sector has not been able to rebound yet, and 2024 is continuing that trend. So if you look at the top left graph, the total amount of dollars invested across seed to Series C is remaining quite stable after the dramatic drop in 2022. However, deal count is increasing. So that is an interesting trend that's different from device and biotech investment. However, we're not seeing the greater excitement of the amount of dollars increased. So if we look at the right, a trend that we're seeing on Series A versus Series B is that Series A funding is dropping while Series B funding did rebound. And I think this is a really interesting trend, especially in device and tools. And it's something that, in diagnostics and tools. And it's something that we're sort of seeing at OUP as well, is sort of the later stage focus for some of these diagnostics and tools. And, maybe not investing too early at a Series A, as you can see, as pre-money valuations and deal size did drop in Series A, but maybe waiting towards more later stage investing in diagnostics and tools, maybe at a Series B, as the company is closer to clinical, or maybe even approved, or closer to commercial, to sort of avoid some of those regulatory and commercial risks and have more of a de-risk approach in investing in this space. Now looking at university diagnostics and tools, this has taken a significant decline since 2021, and continuing to decline from 2023 to 2024. So this is the third consecutive year of VC funding dropping. So dropping about 23% from the prior year and over 60% from the 2021 peak. And then if we look at valuations are continuing to decline as well. So we have a drop in pre-money valuation from 18 to 15 million, and deal size has dropped as well. And I think this just also points to sort of the early stage, risk avoidance of diagnostics and tools that we saw on the private side. Is, investors, may want to wait till a company is more mature and showing sales and revenue growth on the commercial side before diving into diagnostics and tools, rather than making a really early bet early on. And this is sort of the last slide we have for the life science portion of this talk. So this slide outlines, the different investors in life science and the different subsectors, and the investors that have been most active. So as you can see, each sector has its own sort of unique type of VC that invests specifically in that space. And I think that's something that's really important to think about. If you're starting up a company, let's say in health tech or device or biopharma, to sort of know, who are the big players in that space and who specifically invests in this space. Because I think it's important. You want to align with, the investors that know your space. So it's sort of like a reverse diligence in some sense, to know that, these are the players that not only are mandated to fund in your space, but also are experts in your space, and can help fund capital, but also provide some expert knowledge to help move your company forward. Great.
Justin, we have a couple of questions that are life sciences related. That we have a few more questions that are kind of more general, so I'm going to hold off on those until later into the webinar, but the couple that are life science related, I'd like to get to now. So first one from the audience is, are you seeing changes within the types of therapeutics deals that VCs are investing in beyond the larger interest in AI? For example, are there fewer cell therapy, gene therapy deals? Where is the uptick other than AI on the life sciences side?
Yeah, so it's a great question, and I think the asker actually pointed to a correct trend in gene therapy and cell therapy. And this was a space that in 2020 and 2021 saw dramatic investment and dramatic sort of influx of new companies. And I think if today you look at the landscape of cell and gene therapy companies, it's quite a number of companies that it's like too hard to even fit on one page. So investment has definitely decreased in that space, and there is a fundamental reason why. These companies require lots of capital to sort of, one, provide for the manufacturing of cell and gene therapy companies, and then also just move it forward into generating proof of concept data. So in 2021 and 2022, when there was dramatic excitement for, novel, risky but novel approaches, people sort of overlooked, the amount of money it takes to generate exciting data for these companies. And then as time progressed to 2024, investors, are more focused on lower cost, lower capital needed to get to, the questions that we want to answer. So I think as we look to 2024, there definitely are spaces that remain hot, and then also spaces that are up and coming. So I think as cell and gene therapy, has come down a bit, there still is some interest there. But in terms of therapeutic areas, there's tons of interest remaining in obesity, oncology, autoimmune disease, and then I think a new trend that's emerging is excitement in the cardiovascular space. And this is actually tied to obesity in a sense, as some of the GLP-1s has shown exciting data in clearly reducing weight, but some of those outcomes have translated over to the cardiovascular space. And now you have big pharmas that have these GLP-1s and have generated exciting data in cardiovascular outcomes, and now want to continue playing in this space and are looking for, other assets or maybe other combinations that they can combine with current assets, and that's creating a new influx and new interest and investment in that space.
Thanks, Justin. All right, one more question, and then we'll move over to Nabil. We've been seeing many single asset therapeutic startups that are not necessarily a good fit for the model of a huge Series A round. With the trend of less small angel rounds and the NIH uncertainty, do you have suggestions for how we can spin out these assets and perhaps, for example, bundling a few assets together? But what are you kind of seeing in this single assets space?
Yeah, I mean, I still think single assets are still a very interesting approach for biotech. There's two ways to view this. So, it's very interesting from the standpoint of, cost and moving forward on a single thesis, and then also biopharma M&A. So, when you have a large pipeline of drugs, sometimes it's difficult for, big pharma to sort of value the entire pipeline that aligns in a way that, the founders and the company's investors view the value of that. So there's a sort of disconnect when it comes to M&A exit. And then also a trend that we're hearing from pharma is they're actually looking for these, what they call like add-on type of assets to their pipeline, which are like $1 to $5 billion deals. So they're looking for single assets that just kind of slip into their own pipeline. And single assets, companies fit in that sort of area nicely. However, the risk of single asset companies clearly is, if your hypothesis fails and your drug ultimately does not work out, then the company could be done from that standpoint. So it's riskier, so higher risk and higher reward. But I think at the same time, the single asset companies do have a lot of interest if it's in a space, the biology is intact, and it's in a space that investors view as highly attractive. It's not a sort of me too, but maybe a potential best in class or has novel, differentiation. I think those will always, be of interest. And then if, you're a platform company and, may have a huge pipeline where, different assets do not align or don't have synergy, spinning off an asset into, a single company is still something that we're seeing today and has potential.
Great. Thank you so much, Justin. And I do just want to point out, as many of you know, a bunch of this information comes from Silicon Valley Bank, from their healthcare and investments exit report. We're very thankful for this every year. It's a great way for us to compare what's happening in the universities, what's happening versus what's happening overall in the sectors. So thank you for that. And then Nabil, I just want to thank you for answering so many questions on the side. He's been answering some of the Q&A questions that have come in as well. So thank you for doing that. And with that, I'm going to pass it over to you, Nabil.
Thank you. Yeah. All right. First slide.
Go.
Great. All right. So this chart is going to look similar to the one that I showed earlier in this presentation about US VC activity. And that should be no surprise because a good deal of broader funding was tech. So that being said, funding rebounded in 2024. And it's a healthy increase compared to all years except 2021 and 22, of course. But what's interesting here is that deal count continued to decline in conjunction with this funding rebound. So fewer companies continue to amass more of the overall funds that are available. And those companies are likely early stage companies. Late stage companies have stagnated, and actually, valuation resets and down rounds have been a little slower than anticipated due to insiders doing extensions and bridging companies to sustain, those startups that are struggling to meet their growth targets. So it should be no surprise that today's later stage companies are like the 2020, 2021 early stage companies. And they raised at exuberant valuations and need to grow into those valuations as quickly as possible while trying to fend off those significant markdowns and down rounds and things. Next slide. All right. Let's see. So before we, sort of get into the university side of tech funding, I just want to quickly touch on what first-time financings look like. And we define that here as angel and seed funding. In general, the first-time financings have remained pretty steady over the last 4 years. But the big takeaway here is that sharp year-over-year decline that we see since 2021. There were only 183 seed financings for university tech in 2024, which is the lowest we've seen since 2016. And so all this means is that fewer companies are getting seed capital, but the ones that can are getting more money, more of the money that's available to them. Next slide. All right. So that brings me finally to the university-specific tech. And honestly, this chart is going to look very similar to an upcoming chart we have on AI/ML specific funding. It's actually very interesting because this chart for university tech looks more similar to that one for AI/ML than it does for the broad tech chart I showed first. So while I don't have quantifiable evidence for it, anecdotally speaking, we at OUP see a lot of AI/ML startup activity spinning out of university ecosystems. And there are some incredibly talented faculty members and graduate students within CS departments and departments similar across the country working on some amazing projects. And that translates to the incredible deal value we see here. And I'd say, the biggest thing here is that it surpassed 2021 in deal value, while deal count has dropped for the third year in a row. So consistent with a lot of what I've been saying already, the companies that are able to get funding, they're raising some very large rounds at rich valuations. And it's just incredible to see. When we were in 2021, we may not have known that we were kind of in a bubble. And here we are 3 years later, and something else completely different is powering it. And we don't know if it's going to be exactly the same or if it's going to be different. But it's happened nonetheless, and it's being driven by a single sector. All right, so let's see. So this slide is all about kind of dissecting everything that is shown in the trends in the previous slide. What I want to touch on quickly is the left side first, which is showing median deal size by stage. And this kind of for the first time, median early stage deal size surpassed that of later stage, which confirms the hypothesis that later stage round sizes might be struggling a bit more than early stage because their valuations may not be grounded in reality. And so these companies are trying to grow into their valuations from the pandemic bubble, and the smaller deals could be because of inside-led rounds versus those oversubscribed rounds of today that are more on the early stage side. And then I want to turn your attention to that decomposition of university tech funding by sector. That's on the right-hand side. Let's look at just software and physical sciences. So software is in dark green and physical sciences is in light green. And since 2021, software funding quadrupled. And for the first time, it's leading the pack in terms of overall funding. In fact, software alone in 2024 raised more money than all tech funding in 2023, and all is almost the same as 2022. And so the sheer magnitude of interest flowing into AI and ML and related technologies has pushed software funding, into the stratosphere. And so 2024 was the first time in 5 years that software has overtaken physical sciences. And while we know that the majority of software activity is AI and ML, physical sciences has historically been dominated by climate tech funding, at least recently. And so the assumption here is that the slowdown in climate tech is what's driving, the overall slowdown in physical sciences. All right, so this is the chart that I was referring to earlier. So just to drive this point into the ground, we even have a full slide dedicated to just showing you that AI as a sector has really taken over. If I could superimpose the university funding for tech on top of this, the pattern would look almost exactly identical. I think one piece of the AI ML funding we haven't quite touched on here is valuation. And so, these are expensive deals. Just, look at how the median and average pre-money valuations of the space has grown over the last 5 years. The average pre-money valuation doubled from 2023, and the median valuations are up 65%. So, even in later stages, AI ML valuations are pretty sturdy, which is a signal that investors have confidence in these companies to rapidly scale and achieve meaningful revenue. And that brings me to climate tech. So climate tech was down, and climate tech was down, and this is one of the biggest contributors to physical science. And typically, even so, I think the biggest point here to make is the sharp decline in deal count. Right now, investors are really valuing traction over potential. And I think a lot of these companies have incredible technology, and they've made huge promises. And there are some incredible scientific breakthroughs behind these projects. But I think maybe the time has passed for very, very expensive science projects, and now investors are more concerned with how those projects are going to translate into customer contracts and meaningful revenue. And so we've yet to see what's going to happen on the climate tech front in terms of customer revenue and things like that. And so investors are kind of on the sidelines waiting to see how the thesis is going to play out, whether these companies are going to be acquisition targets or whether they can stand alone as public entities. And so we think, within the next, 1 to 2, maybe 3 years, we'll start to have an idea of if it's going to pay off or not. All right. So that brings me to actually my very last slide here. Um, so the charts on the left show broad US VC activity on the top and climate tech on the bottom. And what we have circled here is the peak of 2021. And what I want to draw your attention to is everything that happened afterwards, which we can see is a downturn. The chart on the right is the AI funding chart that we showed earlier today, which is now arriving at what looks like a peak. So, I kind of leave you with this. Are we going to see a similar pattern repeat itself on the heels of AI hype? Or is this trend here to stay for the near future? We'll find out, and we'll see it play out over the next year, and we'll report back again at this time next year. So yeah, well, with that, I'd like to, thank you all. And I know there's a lot of questions, and so
There's a lot of questions. Yes, right. So, and Nabil, one of the questions is, what haven't we talked about here on the physical sciences that is hot? Someone in the audience mentioned quantum and nuclear. You want to talk about some of those other areas in particular that we think are especially interesting right now?
yeah, I would say so. Quantum is still very much, it's still very much in our purview as it is for all other investors. There have been a number of breakthroughs in the sector over the last year. It's still a challenging space to see how companies are going to make money. I think like that's been the biggest thing. Quantum has been around for a very, very long time. And so we may finally be getting close to finding out what what business models might look like in this space and how it can translate to real value, meaningful revenue and value inflection for these companies. Other sectors like nuclear have been very interesting as well. Nuclear fission has been, causing some ripples over the last year. That's as opposed to nuclear fusion, which were some of the biggest deals in 2021 and 22. And that's because fission is a technology that has been around for decades, and it's something we know works. And that kind of speaks to the sentiment of the market itself. This is a technology that exists. We know it works. And so investors are a little bit more open to backing something that kind of has that groundwork already laid out and sort of de-risked, if you will. And that theme kind of plays out to everything that we've discussed today, whether it's biotech or tech. Investors are generally looking for companies that have some sort of product market fit de-risking done, or some technical de-risking done before they start dropping tons and tons of capital into it. And on the biotech side, I'm sure Justin can speak to it. Investors are looking at later clinical stage assets versus those that are preclinical. And I think several years ago, tons and tons of preclinical companies were getting funded, but they were also going public as well, which is not something that we're seeing today.
Justin, you want to comment on that? And Nabil, while he's doing that, there's a question about slide 23 that you might want to just answer.
Sure.
Some side.
Yeah, I mean, I think that's a really good point. And this I think my answer will actually tie into a question that we got in on the Q&A about the trend of less deals and higher amounts. Because that's sort of what we're seeing is, investors are looking for later stage assets because, in an uncertain markets, in uncertain times with sort of all the macroeconomics going now, there's a less appetite for very risky, stage assets. So, there's that trend where, we're looking for maybe instead of an idea with, very early stage preclinical data, maybe something that's closer to an IND and we can fund it into the clinic. Or, I think we're also looking at VCs have been trending at a lot of the VCs we also spoke to are now even looking at clinical stage assets, which already have some, maybe early phase 1 proof of concept data. And, due to some of the depressed valuations we've seen over the past few years, that some of these investments now make sense, as we've seen some down rounds and flat valuation rounds, that now we can invest in companies that actually have clinical data, at lower valuations and see a quicker return on investment than some of the very super early stage investments. And that's not to say I think that, completely, we were not seeing any like seed or pre, DC stage biotech investments. And this is tying into, I think Tarek's question was, I think it's very important to, for the company to address, where the funding or what answers the company will answer with the funding at hand. So if it's like at a seed stage, maybe it's some preclinical data in mice, that's fundamental to the mechanism or the proof of mechanism that we're trying to solve for, and then we'll take clinical risk at the Series A round. And then if it's a Series A round, it's fundamental to show that your dollars will get us to, maybe if it's an oncology company, 20 patients worth of clinical trial data, showing this is our bar for success on whether we should move this forward on efficacy and safety. And I think that really helps the investor if we don't have to ask those questions, and the company sort of presents that to us up front, then that really shows that the company is really thinking like an investor, and thinking ahead on where our dollars could eventually get them.
Awesome. Thanks. And thanks for answering two questions in one there, Justin. I'm going to start with an answer to another question, and I'd love for Justin and Nabil to also chime in here. One of the questions was, are university funds picking up the drop in VC investment? My general understanding is that a lot of the university venture funds, first of all, most of them aren't very big, but they also tend to play in the very early stages of the university startups and funding them, and so they kind of address usually a different pain point of the university startups than typical venture capital funding. And so they're usually earlier money in, and sometimes they're able to follow on rounds, but not always. So I wouldn't necessarily say they are picking up in the drop in VC investment, but maybe somewhat in the more in that angel pre-seed space. But Nabil and Justin, your comments here?
Yeah, I think that's generally correct. I have the same answer. I don't have much
Okay.
to add to that.
Yeah, same here.
Great. Okay.
Happened.
All right. Next question then on we had another question on the VC liquidity problem. Can you talk more about the related trends, perhaps about secondaries or continuation funds, et cetera, and what we're seeing with regards to those?
Yeah.
Nabil, I'll start with you.
Great question. And I'll talk about, so I'm not sure about continuation funds. So that's my short answer for that. However, with secondaries, it is a very real thing, and it's definitely an option. However, it comes at a cost. Oftentimes, secondaries for liquidity may come at a very steep discount. And so you have to make a decision between generating liquidity today versus, perhaps holding on to something longer with the hopes of greater liquidity down the road. And so it's difficult to comment on what is the better decision, but that's the trade-off that you have to make, is whether is the future money in this company worth more than whatever you're going to get today? And theoretically, you're probably better off holding and waiting. But as investors who have a fiduciary duty to their LPs, and you need to generate liquidity and pay your LPs, it may not always be possible. And secondaries have always been around for that reason. And so I'd say it's less often the case that you're ever able to get a premium on a secondary sale, unless you're in an exuberant market and there's some really hype technology that people want a piece of. And generally, you're going to take a haircut on whatever your secondary sale is going to be.
Yeah, maybe just to add on there. So I actually noticed in like maybe 2022, as we started to see these high valuations really depress, that's when I actually noticed there were some VCs that were interested in secondaries. And that's because, they invested at such a high valuation, and, they're seeing the market downturn. So they're looking for a way to, quickly get out and are willing to take that discount that Nabil mentioned, and sort of maybe take that money and put it into something else that already has a depressed valuation. So I actually remember there were banks that were trying to get into this secondary market, and offering services to companies, to sort of get out. However, I think in 2024, as most of the market has come down already, and we've seen like the down rounds and flat rounds, that interest for secondaries might have diminished since 2021 and 2022, as now the companies have depressed valuations, and from here it could be more upside, and better keeping your money in and playing out that upside on your investment hypothesis, than whether getting your money out quickly and before everything drops further down, and then reinvesting that.
All right, thank you both. I'm actually just going to move to our thank you slide. We've got 10 minutes left, but I'm just going to move it to our thank you slide just so that people can see here we are, here are our email addresses, etc. But I'm going to take down the slides at this point. And I know people are going to start dropping off, etc., to get to their next meetings. But I do want to mention that we're going to put a survey into the chat, and it'll also be as you leave the webinar. So please do answer our survey. We really do appreciate it. We look at all of our responses. We help plan these webinars based on that. But I'm going to take down the slides now, and just ask you guys some more questions. Oh,
That's good.
okay. So one question was, and you guys, you talked about discounts, down rounds. Do you guys know what is the average discount on down rounds that you're seeing? Are there particular technology areas that you're seeing? And I'm not sure this is a question that we can actually answer, or that we could look into and maybe follow up with someone afterwards if they have more questions about it.
I could give a quick answer, which is, I know what the discount isn't. Like, it's not like it's not 50%, it's nothing staggering, like, a company worth, 100 million is now worth 50. I think we see less of that. It's usually like round over round for early stage companies. Maybe it's 0.9x from the last round, or 0.8. Like, it's nothing drastic, at least so far. I think the giant haircuts are more on the later stage side. So these are like growth stage companies like Stripe, who are taking massive valuation cuts. And that we feel more because they're already worth $2 billion and they're getting marked down to one. So it's just the sheer dollar impact of it. You can feel it. But I think on the earlier stage side, it's been it's been a little more quiet than you would expect.
Yeah, I think on the life science side, generally the same. However, the one sector where I have seen massive down rounds is cell and gene therapy. And these are companies that, are, advancing in the clinic, generated clinical data. However, as I mentioned, like the cost of these companies is so high, but the other part is what ties in with the high cost is like the efficacy bar for these companies is also really high. Because if it costs so much to make these products, it'll also take a lot to convince investors that this is worth investing in and worth paying for. So we need high efficacy. So in terms of down rounds, like I've seen some companies go to maybe like 400 or 500 million and then do a down round at 100 million. So those have been drastic, and even generating clinical data and still having those massive down rounds. But then in more other sectors, or like oncology or autoimmune, if you're seeing a down round, it's usually not that drastic, as Nabil mentioned.
Great. We only have a couple minutes left, so I kind of want to do rapid fire questions now. Okay. Justin, are you forecasting that tool or device company investment trends will be positively impacted by the influx of embedded or adjacent AI technologies?
I don't know. I don't know. I haven't taken a deep look into device tools and AI. So it would be hard for me to forecast anything. I would suppose eventually, like, AI, if there's one sector that, that would help that AI would help, it would probably be diagnostic and tools the most.
Yeah.
I
All
do,
right, great.
I do
Sorry,
have
go ahead.
a comment there. Um, just on the tech side, so like, healthcare aside, on the tech side, hardware enabled, AI and hardware enabled AI enabled hardware, it's been generally challenging for companies in those space. Um, and so I wouldn't expect it to make a huge impact on the life science side in the near term, just with the pressure that medical devices and diagnostics have generally been seeing, and how difficult it's been for hardware AI companies just in tech. It may take a little while, but like Justin said, maybe eventually AI will be touching everything, and diagnostics seems like a very reason and research tools seems like very reasonable places for it to find a home.
Nabil, next question to you. And Justin, there's another question at the end of the Q&A that might be a good one for you to answer in there. Nabil, tough tech, team versus technology. What's more important, or is the answer going to be both are both are? But is there technology versus team?
Good question. I think any venture investor will tell you that the team is the most important thing. But when you're dealing with deep tech, obviously technology is going to be important. But I think we know that in deep tech, the technology is incredibly challenging, and there's often very, very talented individuals behind it. And so the technical challenges are often binary. Either you will figure it out or you won't. An engineering challenge, you will either figure it out or you won't. These are binary outcomes. And with somebody, with a team that's smart enough, you can figure them out. And that still brings us back to team, which is what I think is the most important. And that's why oftentimes a company may pivot and go into a different direction, and they'll bring new people onto their team, and they'll be incredibly successful. Or the opposite will happen, and that it's all dependent on who are the people running the show and how well they can execute and work together, and drive value inflection after value inflection.
And then Nabil, thank you for that. Data. There's a question in here about data and potentially how that's impacting financing trends as well. We had a whole series on patient data a couple of years ago, maybe actually something for us to talk about on another webinar, just because data and universities, like they're working a lot on this particular area, but any quick thoughts on that? If not, we'll probably save that for another webinar.
Yeah, I don't have a great answer for that at the moment off the top
Okay.
of, but happy to always look into it and follow back up.
All right. We're going to actually do our last final questions here. And I'm sorry, we didn't get to a couple of the questions, but feel free to follow up with our panelists on the questions if you would like. My final questions are top pieces of advice for founders who are trying to fundraise right now. And then can you answer when and will it get better? Which I think was a tongue-in-cheek question that we got in some ways. But I will throw both of those to each of you. So Justin, starting with you.
Yeah, I think a really good piece of advice if you're going out to fundraise for the first time is to fundraise with conviction. I think, people that come out and are trying to test the waters with VCs and saying, oh, I don't know, I'm thinking about fundraising this amount to get to this data, but maybe we'll wait another year. I don't think that's the right approach. I think investors will sort of red flag you as you're not able to make the right decisions at the right time. In turn, if you're coming out with a solid plan, conviction that you need to fundraise now to get to a certain milestone, and you outline that properly for VC and the investors, I think you right away make a better impression on the VC rather than somebody that's trying to test the water. And then, and when will it get better?
Tell me, Jeff.
Yeah.
Yeah, probably don't.
So I mean, there was some optimism, and for tech and specifically for biotech. Unfortunately, a lot of this sort of correlates with, the macroeconomics and the federal rate, policy. And, there was some optimisms towards the second half of last year that, we can uh, decrease the inflation's coming down, and the federal fund rate will also decrease. And then there was a certain change towards the end of last year, and sort of a higher for longer rate policy, and that has unfortunately led to a lot of pessimism in the sector, and you're seeing that specifically on the public market side. Um, when we'll get better, like it's always hard to predict, and I'm hopeful maybe towards the end of this year that as the markets open up, and we're seeing companies get rewarded for positive data, that there'll be increased optimism, and hopefully the macroeconomics play out as well.
Thanks, Justin. Nabil?
I think my favorite piece of advice for any company trying to raise funds is, especially if you're going out for the first time, know your investor. Know who you're asking for funds from. If you're a hardware and robotics company, going to hardware and robotics, at least investors with a track record investing in that vertical, finding them and reaching out to them first is always great, because they can often become your anchor investor. And as a fund that often participates in a syndicate, when we see an anchor investor that has a lot of domain expertise and they're leading the round, it makes it so much easier for the rest of the round to come together. So finding that expert lead will often result in probably a smoother fundraising process in general. And then when will it get better? I wish I had a crystal ball. If I knew the answer, maybe I'd be running a hedge fund. But I think there are signals that things want to get better in the data. But with macroeconomic backdrop and tariffs and things like that, there's a lot of uncertainty and unpredictability in the current markets. And so once some of that prices in over the rest of the year, maybe we'll have a better sense of where things are headed.
Well, thank you both so much for this terrific information and advice to our universities, their companies, et cetera. Really appreciate you putting this all together for us and giving us kind of an overview of what is happening both on the general startup side as well as the university startup side. And thank you to our audience for joining us. I know we went a little bit over time, but we really appreciate you being a part of this, and all of your questions, et cetera. They really help us ahead of time to prepare for this. Please do answer the survey. We do read them. We do plan a lot of our webinars based off of them. So thank you all for joining us today, and have a great rest of your day.